Good morning. This is Barry Knapp with Ironsides Macroeconomics. It's 10:25 a.m. Mountain Time, Monday morning, February 23rd. Equity market is under considerable pressure in the aftermath of the SCOTUS decision on Friday, and our note is titled "Tariffs Are a Tax." So says the Supreme Court of the United States. We began the note with a couple of quotes. Justice Gorsuch's ratchet quote, and then a quote from Roberts, and of course this section from the Constitution that defines tariffs as a tax that is part of Congress's power. And I think those that have concluded that the goal of Gorsuch and Roberts Barrett within the decision that they've made was to force Congress to begin doing their job again. This has been a longstanding theme of ours, going all the way back, even to include the Patriot Act, that Congress has continuously enacted legislation that ceded power to the executive branch, either through an unelected bureaucracy that was allowed to act as judge, jury, and executioner, or directly to the executive branch. And tariffs is one of those, probably the most important example, because that began after Smoot-Hawley in the 30s with a series of legislation acts under Roosevelt, under Nixon, under Reagan, that gave an increasing amount of power to the executive for the power to create tariffs and taxes that, in fact, was Congress's responsibility. So there was a couple of notable things that came out even before that decision that should have had the Fed, and markets have discounted this, but the Fed doesn't seem to have. The first was an Atlanta Fed business inflation survey that is now back below where it was before Liberation Day and below where it was before the pandemic. The idea being that tariffs are in fact disinflationary, whereas the Fed is hell-bent on this thesis that inflation can be modeled by an enhanced or expectation-enhanced Phillips curve, something that doesn't make a heck of a lot of sense to us. But even if they do deeply believe that, this inflation survey should imply that the risk has passed. We also got the trade numbers on Thursday for December, which surprisingly showed a 3.3% increase in imports, even though we already knew that customs duties had fallen 9.3%. They've gone from a range of, call it 30 billion or so a month down to more like 28 billion a month. And that took the effective tariff rate from 12 to 10.6. We've been arguing that the inflationary risk has passed. Certainly Walmart's numbers were supportive of that last week. And the other piece we would add to that is when we saw the personal consumption expenditure numbers last week, not just for the GDP report, but also the monthly personal income and spending numbers. What we've seen happen to goods consumption over the course of 2025 was it declined from 5% annualized growth to negative 0.1%. So a virtual collapse. You tax something, you get less of it. Services spending also slowed from 3.6 down to 1.7. So there is no question that tariffs were an adverse aggregate demand shock, alongside with much slower government spending and much slower immigration. Growth weakened. Don't let anyone tell you otherwise. And here's the numbers from the corporate sector. S&P 500 earnings. We hear all day long on CNBC or Bloomberg or Fox just how strong corporate earnings were in the fourth quarter. 13.6% growth on 8.6% revenues. Sounds great, right? Except when you look ex-tech and comm services, the beneficiaries of the Gen AI boom, were at 6.5 and 6.6. Just so you understand, mid-cycle earnings growth, taking out the sort of 6 months right before a recession, the year after a recession, trend growth is more like 12.5. So we're at half that level. And while it was expected for ex-tech and comm services to accelerate in the first quarter, reports and forward guidance dash that hope because those expectations are down to 5% for the first quarter on 5.4% revenue growth. So the pressure on margin persists, and this is just not a robust economy right now. We are seeing good signs out of capital investment. The durables reports looked pretty good last week. We're going to get a lot of regional Fed surveys. We'll have more to say about that at the end of this week. So we are getting some rebalancing of growth away from consumption towards investment, but it's taking some time to materialize. And in the meantime, we're still dealing with these adverse aggregate demand shocks. The belly of the Treasury curve is down 6 basis points right now. We're at 403 on 10s. We think that that market is really telling you that underlying demand is fairly weak right now. Waller gave a pretty interesting speech about the labor market. We're going to get the Conference Board labor differential on Tuesday, these regional Fed surveys, and of course, a week from Friday, we'll get the next employment report. Chances are it's going to be pretty weak, and it's going to make that January report look like a figment of the BLS's seasonal adjustment factors and smoothing's imagination. So more to come on all this. Barry Neff from Ironsides. If you're not a paid subscriber, we'd love you to consider becoming one. If you need a trial for a period of time, let us know. Shoot us an email. We're happy to do that. Have a good week, everyone. Thank you.